2025 is really shaping up to be the year of the consumer and the year of actual real world utility being driven back to crypto.
Welcome to High Stakes, the podcast committed to demystifying the institutional adoption of blockchain technology. I'm your host, Alex Nwaka, and today we're elevating the Web3 discourse in a series of conversations with industry iconoclasts that are shaping the future of Web3. Now let's get started. Welcome to another episode of High Stakes. I'm your host, Alex Nwaka. Today, I am joined by Charles Mountain, who is the head of ecosystem at Ether.Fi. Welcome, Charles.
Thank you, Alex. Appreciate you having me on.
Yeah, absolutely. And, just to give the audience a little bit of a plug on you, you are somebody after my own heart. You came from sort of the TradFi world as I did and moved into the crypto space and have spent some time in trading and venture capital, as well as, recently crypto and places that, include Citigroup, Hivemind, and now Ether.Fi. So welcome to the High Stakes Pod. Charles, maybe, for the audience, maybe just a quick on, your background and quick flyover of your career trajectory would be really interesting as a starting point.
Yeah, absolutely. It's been quite the journey down the rabbit hole I've taken, a path similar to many others as they've stumbled their way into crypto through the different routes that we've all taken. Everything originally started with back at Citibank, originally came out as a software engineer, kind of interested in the intersection between finance, technology. Quickly realized through my time there the inefficiency of working at, if not one of the largest companies in the world, or over 200,000 employees there at the time, quite literally the perfect definition of being a cog in a larger machine. And so one of my original tasks as an intern was to figure out how to speed up a lot of these manual processes. And for better or worse, hilariously, the finding wasn't anything that I relied on my degree for. It wasn't coming up with some genius architecture or code base. It was actually buying a second printer for the division and putting it closer to their desk. So realize that there's a lot of kind of broken systems at the moment, and there's unique and interesting ways to solve them. And as soon as I kind of caught on to crypto and was able to apply it to a lot of what I was seeing in my daily life, that really caught hold. So worked there for quite some time across different markets, different desks. Ended my career as a quant on the equity options desk. And at the end of that tenure was actually able to put together one of the first, call it markets division crypto products within Citi. So at the time, regulatory compliance was a large issue back then, around 4 years ago at this point, 4 to 5 years. And without having sign off to release a product that generated revenue, it was difficult to get kind of internal interest to back that. One of the routes I had taken, which had eventually driven me more toward the venture path, was realizing one of these, call it unique advantages Citi had, in that they had an internal venture arm, which was able to not only make investments, but utilize the application of those investments to further the promotion and growth of that investment. And so at the time, one of those was Amber Data. We were able to connect with them to actually facilitate a lot of the underlying infrastructure needed to connect to the CME, to build out NDFs on the FX desk. And putting that together kind of put me in a great position in reaching out at that time for the next role in crypto. So jumping forward from that, went through quite a fun interview process at a few firms. Folks may be aware of the infamous kind of Terra Labs was one that I was actually in progress with. Kicked off that interview about 2 weeks before the collapse. So
wow,
great timing there. The role I was interviewing for was moonshot lead. So I think there's a little bit of writing on the wall, but the excitement there was too much to turn down. So after that, looked into kind of different L1s, L2s protocols, but really realized I wanted to kick off my career from a much broader kind of sense. And so found through tie-in through Citi. A lot of folks actually left at the time. There's a Bloomberg article that came out titled "The Mass Exodus of Talent from Citi into Crypto," and part of those folks actually went on to found Hivemind Capital. So that's a New York-based crypto native firm. Had a bull market mandate of as long as you touch crypto, we could invest in it. So we did a mix of liquid token trading, venture investing across most sectors there. Worked there for several years across both of those arms, helped look into what was originally the creation of a Bitcoin mining fund, which later transformed into a digital art fund. That was kind of a fun path there to explore. And most recently moved over to Ether.Fi as head of ecosystem.
Very cool, and touched a lot of bases along the way. It seems like, and a lot of learnings and things in your toolkit, no doubt. Charles, tell us a little bit about Ether.Fi for folks that might be listening in that are unaware of Ether.Fi, which again, hard to miss if you're in the crypto space, but we do get folks that listen in from more of the traditional realm. So maybe just a quick on what Ether.Fi is, sort of the mission, and then we can dive a little bit more into your specific role there.
Yeah, absolutely. I think a lot of the time it's easier to think in kind of inversions or negatives than positives. And so it's almost easier for me to answer at this point what Ether.Fi isn't than what it is, given our scope has increased, so rapidly over the past few quarters. Ether.Fi at its core is a financial services platform within crypto aimed to simplify both access and utility of a lot of these different tools and rails available. And so we have what you can think of from the basic standpoint as a savings product, an earnings product, and a spending product. And each of those have their own kind of unique crypto twist toward it. So starting from the savings product, we are the largest restaking provider in crypto. I will leave the definition of that for a little later on. We can dig into that, but it's essentially a way where we provide both staking services for Ethereum as well as restaking services, which harness the ability of different layers of yield to create what are effectively capitally efficient assets. And we offer those on Ethereum, recently Bitcoin, and soon to be stables as well. On the earnings product, we have what we call liquid, that are essentially one click deposit vaults for Ethereum and USD. We go in and work with a essentially yield manager slash active manager to deploy those into DeFi and allow users who aren't that savvy or don't actually want to spend the time learning all of these financial jargon and nuances to earn better yield on their capital. And then lastly, which is the most recent, next week, we have the spending product we call Ether.Fi Cash. This will actually be a Visa issued credit card, which is backed off of a non-custodial vault on chain. And we work with some of the largest borrow lending platforms such as Aave to facilitate the credit portion of that. And that is our kind of furthest venture into the, call it, retail slash consumer arm as of late.
Awesome and great summary. So Charles, you're obviously a bit new to Ether.Fi, and maybe talk to us a little bit about your role as head of ecosystem. Like, what does that encompass? What does success sort of look like? How is that defined for you? And then my follow-up question is, what's your biggest learning so far being new to Ether.Fi?
Yeah, absolutely. I'd say head of ecosystem is quite a widely encompassing role. Part of what attracted me to it was the ability for it to tie on a lot of the past learnings I've had and gathered along the way. I'd say one portion of it is related to the actual push out of the different restaking, or as we call them, liquid restaking tokens. And so this has been the build out most recently of the trifecta of base assets. So having the most capitally efficient version of Ethereum, Bitcoin, and stablecoins that users will be able to use not only in DeFi, but also to pair with for other assets as well. And so managing on that front, the integrations, the incentives, the cross-chain strategy, as well as the liquidity that goes with that is one portion. The back half of that, which is more of the infrastructure tech piece, is actually managing the restaking layer to that. And so you can think of our product as Ethereum as the kind of core underlying backing as a base asset. We restake those similar to, I should say, we stake those similar to other staking providers. And so that is rewards inherent to the network itself. But most recently, there's been a new addition to DeFi as a whole called restaking, where you're able to effectively reuse that collateral to secure other services other than just the security of the Ethereum network. And so on the restaking layer, it's essentially managing the delegation of that Ethereum to our partners. It's evaluating the risk that comes with those, as well as composing the overall return profile of that kind of layer that we'll be bringing to users. And so beyond that, in combination of those two, I'd say the fastest and quickest learning for me has been the pace at which the developer side moves in the ecosystem. I'd say that before I thought that I was working hard in venture, but learning kind of the new way that things run and the different avenues that we've pushed has been incredibly exciting and exhilarating. And it's tough to actually fight off all of these kind of different fronts at once. And so figuring out, prioritization, organization of these different pushes has been kind of the greatest learning on my front. And it's been incredibly impactful to be able to pull partnerships on the Bitcoin front with a team, Lombard, we're working closely with to bring Babylon and Bitcoin staking yield out into Ethereum, as well as on the stablecoin front, partnering with Athena to bring both treasury and basis yield out to Ethereum as well, are kind of great avenues that Impact has been able to be made already, and we're seeing great growth on those products.
Awesome. And when you think about the craziest success story that you could be telling about restaking, and specifically on Ethereum, when you think about what that looks like in the future, is that what are the implications for security, decentralization, staking yields? I'm just curious, maybe even to zoom out, right, on like what is restaking going to mean for some of these networks and protocols, but specifically Ethereum in this case.
Yeah, absolutely. I think that restaking as a topic is one that's still being digested by the top experts in the space. I'd say the definition of it changes almost daily along with the underlying architecture and structure. But at its core, I think we can define restaking as providing economic security to other services within the crypto ecosystem. And so at that layer, I think the biggest unlock is the ability to essentially offer the same level of anti-fragility that we lean on ETH out toward the actual dApps on it as well. And so I think the kind of unspoken truth or hidden under the rug feature is that a lot of these recent advancements have made sacrifices to decentralization in order to accommodate scale as well as other aspects. And so when we look at layer twos, for example, a lot of those rely on centralized sequencers as well as other multi-sig wallets, which back some of the core infrastructure pieces. I think what restaking enables uniquely there is the ability for a lot of these apps to be able to decentralize those core features and core pieces of their infrastructure in a way that wasn't possible before. And so I think we'll see this expansion of what we call AVSs, which are actively validated services in restaking, which will be the ability for apps to effectively capture value from adding utility to their own token through effectively bringing that into the restaking ecosystem and being able to decentralize core pieces of their own tech stack.
And maybe to build off of that, what do you think is the most misunderstood thing about staking and restaking? I'm sure you see a lot of different folks that you engage with that are more or less savvy on those concepts. But what is sort of in your mind, the most misunderstood thing about it?
I'd say it's kind of the nascent ecosystem as well as economic model surrounding restaking, particularly the generation of yield. I think a lot of the user base has been scared off, rightly so, from the past cycle in misunderstanding where the source of yield was. And I think the lesson we've all learned is that if you can't pinpoint where the yield is coming from, it's likely that you're the yield yourself. And so I think getting that communication out to users is very core. It's something that's one of our main focuses in the upcoming season 4 that we'll be releasing in the next few weeks. And that will be the underlying shift to sustainability, where we'll be scaling off of token emissions from our side and highlighting the restaking reward portion of our LRTs. And so with that, it's understanding that these AVSs will have their own economic models, their own revenue generation, and ways that we can actually drive a synergistic flow of usage and joint product build out with these AVSs, which will drive fees toward them and ultimately rewards back to our users.
Mm-hmm. So I was just consulting DeFi Llama this morning, and I saw that you guys are at sort of 5.6 billion in TVL, like plus or minus, and really in the top five, pretty safely on the restaking side. Talk a little bit about how you would frame the fundamentals that drive growth of restaking, and maybe specifically how you think about it at Ether.Fi. Unpack that for us.
The biggest unlock to me is the scale in which restaking can operate. I think we've seen the holy grail on Bitcoin being this chasing of underlying yield to that component, and it's not so different in the restaking and Ethereum ecosystem, in the sense that the value capture that restaking's had and the rapid growth we've seen, I'd say rivals, the initial days of DeFi summer really. And it's been an exciting expansion to see that growth and also harness it in a way that we're able to utilize that economic security in a way that provides value throughout kind of the entire ecosystem, regardless of it being directly on mainnet or on other L2s. I would say a lot of the growth stems from the fact that at the moment you could consider outside of the smart contract portion this yield to be somewhat risk-free yield, given that slashing, which is the punishment of bad actors, not yet being turned on. And so this has effectively funneled a lot of idle capital that was originally staking or sitting plain in wallets over into the restaking ecosystem. And ultimately, I think the continued growth of the risk-free side of restaking, which may be a bit of a controversial take when we're continuing to work out the actual slashing, call it risks and benefits there. But I think ultimately the non-slashing side of restaking is what will take off and continue to sort of scale the next 6 months and beyond.
Mm-hmm. So I always like to try to find a TradFi industry comp to any particular paradigm or company. And so as it relates to Ether.Fi, what's the best way to sort of think about Ether.Fi relative to like a traditional TradFi industry comp? Is it an asset allocator? Is it a capital allocator? My view is it's a bit of a capital allocator where economic security is currency. But I'm curious how you think about it, and we can sort of dive into this and what the implications are potentially, right, for a broader set of audiences.
Yeah, absolutely. I think it's a mix of all of the above. I mean, ultimately, it is a financial network, and we're expanding beyond the initial approach of restaking, which helped us, originally scale and has been our bread and butter services, more towards a consumer focused company. And so I think, comparables you could think of would be some mix of PayPal along with, call it, even a social layer as well. And so I think a lot of those components you'll start to see come out once we have the cash product. We have a lot of neat features there we're planning to roll out with, including 3% cash back on the credit card for any spending. We'll have additional perks we'll be able to roll out with in DeFi. And we'll really bring kind of that layer to the forefront as that product matures. I would say the other way to look at Ether.Fi is once again as this one-stop shop platform where we'd like to be able to host the summation of different products and services, similar to how Amazon and AWS have taken kind of this firm grasp over, initially it was kind of called books and then transitioned to an online marketplace and then the build out of the AWS infrastructure. Similarly, beyond kind of savings, earnings, and spending, the synergistic capabilities of all of these products only continue to strengthen given that they all have kind of direct tie-ins and flywheels with each other.
So I'd be interested in sort of your philosophical take on what sort of shared security means for really innovation velocity. And what I mean by that is if you think about a project being launched before restaking was sort of a thing, that project would have to go bootstrap consensus. It would need to go find validators. It would need to go find a large amount of potentially venture capital investment. With restaking, a lot of that changes a bit. And I'm curious if you see that as a positive externality for the industry, how you think that maybe impacts, sort of the efficiency maybe of how dollars are invested. Just given your venture background, I'm curious how you see, sort of that overall impact of restaking and what it has in terms of the velocity of innovation and sort of the growth of sort of individual projects.
I think conclusion up front, it absolutely accelerates that adoption and innovation curve. I would say the outcome of that is double-edged. And so what we've seen in crypto, particularly in kind of social consumer gaming sectors, is that we've created this almost inverted V structure of trying to hyper financialize lightning in a bottle and allowing this kind of untapped layer of growth combined with token incentives to effectively find equilibrium far too fast. And we see this immediate kind of spike in the short term and then crash on the other side. I think one of the recent cases of that to study would be, Friendtech and the giant kind of wave of general hype as well as backing that had on launch, and then the immediate kind of realization of those untapped externalities that effectively, when we look at eigenlayer, when we look at symbiotic, those models in implementing sort of TVL restrictions as well as other restrictions on growth has greatly benefited them. And I think that's something that will continue to grow in terms of adoption within the ecosystem, is finding this right balance and tipping point between how fast we're able to actually scale these models and networks, whether it be, the success in DePIN of scaling physical networks or the success of social networks. You've kind of gone from one end of the spectrum in Web 2 where it's incredibly difficult to bootstrap to get these kind of off the ground, to Web 3 where you can have a full 3-year cycle play out in a matter of 3 weeks.
And I think that's really an exciting thing about the Web3 space, right? Is just the amount of innovation that can happen. But to your point, it is, a bit of a double-edged sword in terms of, when you're a hammer, everything looks like a nail, so to speak. And so totally get that perspective. You talked a little bit, Charles, about, really moving, sort of in a direction of retail and a lot of focus area on different products targeted at retail. I'd be curious, though, thinking a little bit about how you see sort of restaking and sort of the institutional space and where there's intersectionality there, if at all. And so curious what your experience has been and what your take is on that and how it might evolve over time.
Absolutely. Well, I think we're still quite early on the institutional adoption side. There are, still steps that need to be taken with onboarding the staking component of Ethereum onto US ETFs, as well as generally getting the understanding of what Ethereum tackles and has to offer broader in the industry. it wasn't only until a few weeks back that Bitcoin was even approved for brokers soliciting across these different banks. And so this is just a process that is a slow grind, and the relationships take a long amount of time and trust to build. And so I have no doubt that we will get there. I think the greatest tie-in with institutions will be how we're able to construct this risk-free portion of restaking yield on top of staking, which will provide the backing to services, whether it be oracles or cross-chain messaging or other kind of use cases that we've seen develop in the restaking ecosystem in a way that balances the capital at risk within them, as well as the underlying kind of composition of assets that we'll see evolve initially from Ethereum, beyond that toward both Bitcoin and stables. And so those conversations are ones that we're having on a weekly basis with some of the larger names that are familiar to folks in the financial industry, and we hope to provide one of those and be one of those providers for not only the ETF but potentially actually involving restaking in the ETFs as well.
Super interesting. When you think about the technologies that are, emerging today that have the greatest potential to impact staking and restaking. So here I'm thinking, distributed validator technology as an example. What are the technologies that you're watching and that you actually think have will likely have the most impact in the next 2 to 3 years in the staking and restaking space?
Yeah, it's a great question. I'd say on the staking front, distributed validator technology is something that is critical to scaling the solo staking operation of a lot of these protocols. I think we see, similar to Bitcoin mining, a lot of centralization risks across the actual staking layer in Ethereum to a much different degree than Bitcoin, but one that is nonetheless something we have to be aware of over the next 3 to 5 to 10 years. The ability for us to use decentralized validator technology to effectively group solo stakers into different sets of clusters and schemes that kind of improve the underlying availability and reliability to let them compete with these dedicated node operators with sort of hard metal, bare metal in both data centers across different geolocations is something that we are not only exploring, but also working with both Obol and SSV, two of the largest DVT providers, to continue scaling that portion of our infrastructure. I'd say beyond that, something that I've been kicking the tires on with them in particular is also working on a similar sort of technology for restaking itself. I think that there will be a lot of ongoing decisions and rebalancing that will have to be made, specifically as these decisions have to be allocated toward the different kind of AVSs that function within the restaking ecosystem. And so you'll see kind of the rebalancing based on yield, based on risk, and based on other metrics that we evaluate that could go on, ideally on a much more frequent basis, whether that be weekly, daily, or even hourly in the future. And so finding out a way that we can effectively monitor and scale that will be really critical to optimizing the restaking yield layer of our LRTs.
This is a bit of a harder question, but if we're looking back 5 years from now, and we're wondering what didn't work with restaking, either because it never took off or doesn't exist in the same form with the same promise that it does today. What do you think is the postmortem on that scenario in terms of what didn't happen or what went potentially wrong?
There's a lot of different ways to take that, and looking at that from a post-mortem sense. I would say evaluating the restaking sector at a whole at the moment, there's probably a lack of focus on the actual commercial aspects of a lot of these products. I'd say there's a great layer of neat innovation and strong founders solving difficult problems, but not all of these problems are needed to the same degree in terms of the issues that crypto's facing as a whole and as a sector at the moment. And so sometimes I think we can get ourselves caught up, way too far down the niche of incremental improvements to the tech stack and to decentralization when often you zoom out and realize the issue is actually with monetization or fees or even capturing users in the first place. And I think this is something that is a broader issue within crypto at the moment in terms of the funding markets coming from VC, as well as the actual kind of capital deployment and call it TGE structure that we see at the moment of low float, high FDV tokens, particularly in the infrastructure sphere. And inherent to that is the underlying issue that a lot of these are based on future growth. Yet when you actually back out the numbers as to what is each user valued at on these infrastructure, call it blockchains, protocols, etc., we get some, quite funny, call it cost of acquisition numbers across them. And so I think one of the highlights out of the last couple of years was on some of the gaming sides. Back when we had the vision of the decentralized metaverse, some of those billion-dollar projects had a user base of less than 10 users, and so we are valuing each user at well over 10 to $100 million. So I think refocusing, and this is kind of part of the benefits of the booms and busts and slowdowns within the crypto cycle, is that we do get a lot of these consolidation periods. And I think AVSs in particular will have one of these consolidation periods in the next few months where we'll effectively see, once rewards go live from the Eigen side, the fact that they've chosen a structure that will be fee matching, the fact that that puts the onus on these AVSs to actually generate revenue that they can give out will kind of show the cream of the crop to the bottom of the barrel in quite short order.
And then maybe taking it back to your role ecosystem at Ether.Fi specifically, when you think about what makes ecosystem unique at Ether.Fi relative to other players in the market, wanted to just give you an opportunity to talk a little bit about that and how you see that as being, a real differentiator, especially as the market continues to evolve.
Yeah, absolutely. I think one of our strongest points, as well as my general interest in joining Ether.Fi, was the fact that we sit at the asset layer, which is quite agnostic to most of the sectors and pieces of infrastructure within crypto. And so being able to push base assets across different protocols, across different blockchains, really sets us up to effectively capitalize regardless of the direction of the market. I think being able to provide a base asset layer of high yielding, capitally efficient LRTs is positioning us in a way where we will be kind of the household go-to for any application that launches, whether they want to work in Ethereum, Bitcoin, or stablecoins. They know that we will have a brand name, EETH, EBTC, EUSD, that they can work with us, pair with our assets, and offer their users what is the best experience and utility within the DeFi ecosystem.
Any announcements that you want to hint at? No, you mentioned the credit card, being something that was a recent announcement that I saw in the press. But any initiatives you want to highlight or tease at, for the audience or for the ecosystem?
Yeah, absolutely. Always happy to drop a bit of alpha where I can. I think folks will be pleasantly surprised by the reward mechanics going out in season 4. Now, we've outlined this in a temp check governance proposal that we've laid out on our forums. I would say not that many folks are interested in governance in general across crypto. And so, not many people have kind of really dove into the details that we've hinted at there. I think the kind of piece that will really unlock the next stage of growth is given our positioning and market share across eigenlayers, symbiotic, and Carrick as these restaking protocols. We're actually making quite a large push toward standardizing a lot of these models and aggregation layers across restaking. And so there's an issue currently at the moment with how the rewards layer functions and the fact that a lot of these AVSs will have their own set of rewards, their own set of tokens, which makes it untenable and unfeasible for users to effectively pay for gas and claim them across the different networks. We are going out and working with other LRT partners in providing this effective public good, which will look like an index for AVXs to some degree. And so what you'll be able to do is from the user flow effectively you'll work with a singular token, which is backed by a pool of these AVS rewards that will have its own set of DeFi utility across DEXs, borrow lending, perps, etc. And what's really neat there is sort of the additional layers that we'll be able to build out on top of that. And we're effectively also solving this supply sink issue for AVSs. And so, I think we'll see kind of the re-heightened interest in restaking as rewards go out, as AVSs start to TGE through Q4 and beyond, and hoping to be at the forefront of that.
Excellent. So last question, which is our high stakes hot take question. So we ask all of our guests to provide a hot take for 2024. Any big milestones or predictions for the Web3 space for the balance of the year?
Yeah, absolutely. I think this has been said many times before, and most folks, I believe, will be proven to be correct, but have only gotten the timing wrong. And I'm willing to step out here on record and give a prediction. But I think finally enough pieces of the infrastructure have come together, especially with our cash card showing that 2025 is really shaping up to be the year of the consumer and the year of actual real world utility being driven back to crypto. I think there's been a hiatus and departure from that over the past few years as the cleanup from FTX and other kind of bad actors have been cleaned up. Beyond that, I think we'll see kind of the re-heightened interest in a lot of these pieces have been simplified for users, whether it be on-ramping, off-ramping, onboarding. Even with our cash product, we'll have passkeys integrated with an Android app, an Apple app, and have this in a function where a lot of the actual underlying infrastructure is abstracted away, which ultimately I believe is everyone's goal here in crypto, is not to make users aware of what's going on behind the scenes, but actually to provide a decentralized, trustless, robust and stable economic utility there, which we'll be able to see play out, and excited to see kind of 2025 be the year of the consumer.
You and us both, right? Charles, thanks for coming on High Stakes. It was really a pleasure having you on, and we look forward to having you back soon.
Absolutely. Thanks for your time, Alex.
Keep exploring and keep innovating. Learn more at validationcloud.io and follow us on X and LinkedIn to stay connected as we continue to shape Web3 for institutions. This is High Stakes with Alex Nwaka, signing off.